The purpose of the customer exception report is to highlight if there is a risk in the future profitability of a business as a result of trends in new customer acquisition and customer retention. The report will only be produced if there is a risk of future profitability decline. The report is presented in 3 sections. The first analyzes existing trends within a company's customer base. The second provides some scenario modeling around the customer base. And the third analyzes the effectiveness of any marketing expenditure. And finally, the report also provides guidance on the recommended course of action. The first section analyzes the existing customer base to help the reader understand why the report has been produced. Comments are provided around new customer acquisition, existing customer retention, and sales profiles. The impact of any negative movement on sales and profit is then expressed below. You are then presented with 3 scenarios which show the impact movements in customer acquisition and customer retention has on the future profitability of the business. Scenario 1 assumes the current trends for new customer acquisition and customer retention continue. As with all VFD Pro reporting, a new customer is identified as a customer who has had a transaction in the most recent 12 months, but not the previous 12 months. Existing customers are those with a transaction in the most recent 12 months and also the previous 12 months. And lost customers are those customers that have not had a transaction in the most recent 12 months, but did have a transaction in the previous 12 months. In this example, new customer growth will continue to decline at 19.4%, and customer retention will continue to decline at around 9.5%. The impact this has on total customers is then displayed at the top of the section. Those customers retained and lost from the previous year are also highlighted. The average transactions per customer and the average transaction value are assumed to remain the same throughout the scenario. A projection for total sales is then provided. Margin rates and overheads are assumed to remain the same, providing a projection of future profitability. The impact of all of these assumptions are then expressed in the paragraph at the top of the section. Scenario 2 highlights the impact on future profitability of the new customers acquired and the existing customers retained remaining the same as the previous 12 months. In this example, we continue to acquire 79 new customers each year, and we continue to retain 51.1% of customers from the previous year. If either scenario 1 or scenario 2 suggest a decrease in the future profitability of the business, the customer exception report will be produced. Scenario 3 then highlights the impact a 10% increase in new customer acquisition and customer retention has on the future profitability of the business. The projections assume a ceiling of 85% for customer retention rate. Therefore, once the customer retention rate reaches 85%, there will be no further increases applied. All 3 scenarios use the business growth model as their basis for calculation. Therefore, if you would like to prepare a bespoke projection, this can be achieved using the business growth model. The final section of the report analyzes marketing-related expenditure over the past 3 years. Any transaction is deemed to be marketing-related if it is coded to a nominal that has the description of either advertising, marketing, or promotion. First, you are provided with a high-level analysis of total marketing-related expenditure. If there are no transactions present within nominals containing either advertising, marketing, or promotion over the past 3 years, this section will not be produced. The marketing-related expenditure is then compared to our customer base. Marketing-related expenditure is divided by the total number of new customers acquired to provide us with a cost per new customer. The same number is then divided by total customers in each of the last 3 years to provide us with a cost per customer. Finally, we compare this expenditure to the sales generated in each of the last 3 years to identify the revenue generated for every pound of marketing-related expenditure. Finally, those suppliers with the highest amount of marketing-related expenditure over the past 3 years are then identified. The final page then provides a detailed breakdown of marketing-related expenditure for each of the main suppliers over the past 3 years.